All right, so I want to go over my trades this week. So first of all, first line, as you can see here, I've got a naked put on Spotify expiring July 10th. So I'm trying this new thing, doing naked puts from Monday to Friday. And this week I decided to go with Spotify again because IVR or IV rank was high. So it had high implied volatility. And I sold a 250, which on Monday morning when I sold the 250 put, it was giving me that it had an 80% chance of winning. Sold it for $1.80, and right now, as you can see, it's trading between 165 and 185. And actually yesterday it closed at around $4. So yesterday I was down a lot, almost $300, or actually sorry, $200, because Spotify dropped yesterday from 270 to 257. But now today it's doing better. It's back up again. It's at 264, reached a high of 267.74, but still not enough for me to close the trade. Or I could get out of the trade if I'm scared and for break even, but if I want to make a profit, then I have to stay in the trade. Right now I'm 15 points away from the short strike of 250, but I know Spotify can move hard easily in 1 or 2 days, especially that the market is already swinging, especially that the market on its own is up and down like crazy. I mean, we saw SPY at 317 this morning, and now it's at 315.6. So I have these put spreads. They were initially put spreads on the SPY they were monthlies. So one of them is expiring tomorrow, July 8th. The other one is expiring Friday, July 10th. And they were initially put spreads that were tested. So I sold call spreads against them. And then the call spreads got tested, so I brought the put spreads even higher. So now they've become iron butterflies. So in total, I collected about $2.80 in credits from these trades. They're 5-point wide. So my max loss is $5 minus 2.8 times the number of contracts. But right now, this July 8th one, for example, I can close it right now for about $3.35. So remember, I collected 280. So I would lose about 50 cents times 2 contracts. So if I close this right now, I would lose about $100. Now, if I try to close the July 10 one, which has 2 days to go or 3 days to go, it has a 315 short strike. Let's see what it's worth. I could close for about 350. I collected about 280 in credits. So this one I would lose about $140 total. So 350 minus 280 times 2 contracts, because I've got 2 contracts. So that's about $140 if I close it now. Or I could wait. So for example, for this one expires tomorrow, I could wait tomorrow. But the only way I get a better price at closing it is if it gets close to 313. So if it gets closer to 313 tomorrow, then I can actually close it for a profit or a much better price. But if it goes away from 313, then I'm going to have to close it for a lot. And then I've got the July 10 here, which is 315, which has a 315 short strike. So basically I need SPY to be as close as possible to 315 come Friday. My break even to not lose any money is that on expiration for the July 8th one, this one needs to be at 313 plus 2.8, so about 316 and about 310. So between 310 and 316 is my break even for this one here. And for this one here, July 10, my break even is about 318 to 312. That's my break even on expiration date. So if SPY stays in this range tomorrow, Thursday, and Friday, I could probably come out of this without losing much money. Now, I was doing weekly. I stopped doing it. I was doing Monday to Monday, Wednesday to Wednesday, Friday to Friday, SPY put spreads. They were doing very well, actually. I don't think I lost on any of them, but I wanted to try naked puts. I wanted to try Monday to Friday naked puts. The reason for that is when I was back testing, I noticed that the weekend usually brings the most fluctuation. Going from Friday to Monday is where you would have the biggest surprise. So when you start the week on Monday and try to and go for that same week expiration, there's usually, and I say usually, there's usually less surprise, less fluctuation. But when you cross the weekend, that's where you can get the big swings, and then it becomes hard to manage. So that's why I wanted to try the naked puts. I could do it with put spreads as well, but with naked puts, I collect more. Like for example, with the same strike, if I did a put spread at 250, I would probably collect maybe 70 cents, risking $4.30. So I know what my max loss is if I do a spread. But with the naked put, I'm collecting $1.80, so I'm collecting way more. It's easier to close as well. It's easier to manage. If my break even is wider, so with my put spread, if I collected 80 cents, my break even is 250 minus 80 cents, so 249.2. But with a naked put, my break even is 248.2. So my break even is wider. Plus, if I have to sell calls to mitigate this trade, I'm going to collect more from the calls as well, because it's not a call spread, it'll be a naked call. So it makes my break even wider. But it is dangerous, it is scary, because if Spotify opens at 240 or 230, my max loss becomes $2,000, right? So $20 times 100 shares times 100. Speaking of probabilities, it's unlikely that it opens on Monday at 270 and then closes the week at 240 or 230. Plus, according to the probabilities, this strike has a 80% chance of winning. But I'm still not convinced if I'm going to continue with naked puts, because it's a little bit stressful. It doesn't, maybe it's not meant for me. It doesn't match my personality, because I keep worrying about it. I like the put spreads, even if it crosses the weekend, because it doesn't take much stress or effort from me, even though some of them will lose. But I know most of them do end up winners, except of course if we go through another March 2020. And that's why I wanted to do from Monday to Friday, because from Monday to Friday, I would have survived March 2020 much better. But crossing the weekend with the March 2020 is what got me in trouble. So maybe I could just do put spreads then from Monday to Friday. That's also another possibility I have to look into. But definitely I like the Monday to Friday, whether it's a put spread or a naked put. And I also like my put spreads from Monday, Wednesday, Friday, 7 days expiration. So Monday to Monday, Wednesday to Wednesday, Friday to Friday. But I just have to decide which one I want to continue with. I don't want to be doing several things at the same time, because then it becomes hard to manage. I just want to pick something and just commit to it. And as we're talking, the SPY is dropping, and I can actually close this iron butterfly here for $3.20. So I would lose about $80 now. Instead of $100, it would be an $80 loss. Looks like the SPY is taking a hit. Let's see what's going on with Spotify here. So if I look up Spotify, it's trading at 262. My short strike is 250. So I really just needed to stay above 250 by Friday, or if time goes by, I can get out of the trade for 50%. I already have an order to close it for 90 cents, but it's not getting close. It's not happening, because it just keeps dropping. We'll see what happens. In my TFSA though, I still have the Qs. I want to get rid of it, because I don't think it's capital efficient to just hold on to it and collect a few cents. So right now, if I keep it, let's say, and I want to sell for next week, so buy back the July 17, let's say, and then sell the week after. So the week after is July 24th. I'm gonna have to take the same strike. So that's the first thing. I can't even move up in strike for a credit. If I want to try to get a credit, I can't even do it for a higher strike. It has to be the same strike. So if I go for a higher strike, you could see it's for a debit. But if I take the same strike, I could do it for a credit, and it's going to be a small credit. So it's going to be 56 minus 17 divided by 2 about. So it's going to be like $20 credit, even less, just to keep rolling this call option forward. And so 20 cents divided by my 213 price or strike, that's per week, whatever percentage that is, times 52, that's about 5% a year. So I'm not sure it's worth holding up the capital for that. So maybe I'll just get my money back, get my capital back, and use it towards something else. The problem is I don't know what to use it against. I don't know what to put it in. I'm thinking of doing the same thing that I'm doing in my margin account. So I'm doing naked puts from Monday to Friday. I could do something similar in my TFSA, which would be, for example, if I wanted to do a naked put on IWM. So if I wanted to do a naked put on IWM, the way I do it normally is I look at the straddle value, and I see the straddle value 141 or 141.5 is about $4. So then I would go remove $4 from the current market price, and that would be my short strike that I would use. So 142 minus 4, so about 138. So then I would sell the 138 put, and actually let's go see what it's worth. So the 138 put is worth about 70 cents. Okay, now in a TFSA you can't sell naked puts, but what I could do instead is sell a covered call. an in the money covered call. So I could go pick covered call here, and I would pick the same strike. So if I go for the 138 strike, you can see that I can buy it. I can buy the stock plus sell the call option, and my net debit would be 137.3 about. So the same thing as the naked put, 70 cents about. So I would collect about 70 cents if IWM stays above 138 come this Friday. So it's the same idea, same thing as a naked put, except that with the covered call, I'm putting up money. I'm actually buying the shares and selling a call option. But the call option is worth so much that it's actually allowing me to go lower than the strike price of 138. 138 is my maximum selling price come Friday. So if the stock is trading above 138, I lose my shares at 138. But I don't care. I paid 137.3, so I basically just confirmed a $70 profit, which would be the same thing if I had just sold a naked put on IWM for Friday. So this is the way around selling a naked put in a registered account. Basically, it's doing a in the money covered call. So if you plan on going from Monday to Friday, whatever your expiry is, you were planning on doing with a naked put, you could do it in a registered account using an in the money covered call. The only difference is, what will you do if the stock goes below your strike? Are you keeping the stock? Are you selling it for a loss and then going back in on Monday? Are you will you sell a call option again at a lower strike? So the approach is going to be different from person to person. So that's something that we all have to decide. With a naked put, if it gets tested, you can actually roll it. You can sell another put at the same strike for the following week and still collect the credit while you wait for the stock to come back up. You could do the same thing with covered calls, but if the stock is really down, you might not get enough premium. So in my RSP, I sold that call option that I always sell, an out of the money call option on my 100 shares of IWM. So I'm down on the shares, but I keep collecting call premiums by selling an out of the money covered call. So I sold the 151 call on Monday, collected 34 cents or $34, and it's worth 5 cents already. So I'm already making a profit of $29. I'll just let it expire worthless. Or what I could do is bring it lower. I could buy this back and then sell maybe the 145 call option. But then I'm playing with fire, because then there's a risk that IWM moves up and hits my 145 strike. So I'd rather not. I'll just leave it as is. And next Monday is a new week. All I care about is that every week I'm collecting something from my position. And it's kind of like a dividend, right? So $34, $31, $38, $35, $36. This is every week from IWM. That was the plan initially with the Qs, is to sell out of the money covered calls, but the Qs just went way past my strikes every time, so I couldn't catch up. And now the Q is at 257. I think it was at 260 today, and my last strike is 213. So I'm missing out on all this capital appreciation from 258 to 213. I'm missing out on that. My max selling price will be 213. But all I could do is keep collecting premiums. But like I said, I think I'm going to get out of this position and use the capital towards something else. And yes, my cost was 221, so I probably lost a little bit. But I did collect enough premiums to make up for the difference between 221 and 213. So this probably wasn't a successful trade overall. I could have done better if I just bought and hold. But of course, I didn't know that the Qs would fly like that. Now the question is, what do I use the capital on? And like I mentioned, I'm leaning towards doing in the money covered calls from Monday to Friday. I find that it has a good chance of winning if I always take the 80% strike, 80% probability of winning strike, and just repeating week after week. Some weeks I might lose. I think personally the strategy that I would take is I would probably get out of the trade. So for example, if I do an in the money covered call on IWM from Monday to Friday, so where's the covered call? Covered call is over here. So let's say I take the 140 strike. Normally I would take the 138. So actually let me choose all strikes here. Look, I've got 3 days to go on this. So if I take the 138, because that's probably the 80%, that's probably the strike that has an 80% chance of winning. And now I'm going to show you where can I get the probabilities. But if I do the 138 and I pay a 137.35, let's say, and IWM stays anywhere above 138, which has a good chance of doing that, then I make my confirmed profit, get my capital back. Next Monday I'll repeat. But if it does drop below 137.35, which is my break even, I'll just sell the shares for whatever price it's at. If it drops to 135, for example, I'll sell it at 135. I would have lost $2, times 100, so $200. But I get my capital back. I avoid going through the weekend, and on Monday I just place a new trade again, and hopefully, because it's a trade that has an 80% chance of winning, I should win 80% of the time. So hopefully the 20% chances, 20% of the time where I lose should not be big losses that will eat up the profits from the 80% winning trades. And so to show you the probability, usually you can use delta, but sometimes Questrade's delta isn't always accurate. So I go to IQ Edge to get the probability of success. So I'm going to log out of Questrade, the browser version, and I'm going to log into Questrade IQ Edge, which is the desktop version of Questrade. So it's a bit more advanced. I don't like it because it's not very user friendly if you're not an advanced trader. But so basically this is IQ Edge. I removed everything, but I'd go look at options. So you see there's options here. I click on it, it opens an option chain. I look up the stock that I want. So I'm looking for IWM, for example. So I'll just search IWM. I'll leave call puts here. I'll pick the expiry July 10. I'll click on all strikes. And see, I've got July 10, it shows here. I've got my calls are here, my puts are here. My in the money probability is what I'm looking at here. So if I look for the 20%, which is around 138.5 and 138, so you see perfect. So the 138, basically this probability here says that this strike has an 18% chance of being in the money come Friday. So basically if that's the strike I choose for my in the money cover call, that means my trade has an 80% chance of winning. It has an 80% chance, IWM has an 80% chance of staying above 138 come July 10. That's what this means here. And I would collect 70 cents, or what I should look at, not at the dollar amount, but let's look at the percentage or the return. So it would be about 138 divided by 137.3. So that's about 0.5%. So minus 1 times 52 weeks just to annualize it. So that would be about 26% a year if I'm able to do that every week. Now, I'm not going to be able to do that every week because there will be losing weeks, and the premiums aren't going to be the same value every time. So I might not be getting the same return every week, even if it's a winning trade. But that's the idea. That's what I'm thinking of doing right now in my registered accounts, or at least in my TFSA, because my Qs are just useless. I was also thinking of doing dividend investing, but I don't know. I'm not too sure. I like dividend investing, but I wish I started it a long time ago. But I think right now for someone who wants to use his capital to generate income, right now, I don't think dividend investing is suitable because it takes time to build. I'm not going to invest my capital right now to get 4% dividends per year. The advantage of dividends is if you had invested 15 years ago, you'd be getting probably 15 or 20% of your original capital. And the dividends per year increase year after year without you doing anything. But that's not something I can benefit from right now. It's only something that I can benefit from in the future. And I kind of want to benefit from my capital right now. So that's why I'm sticking with selling premiums. But I'm just looking or searching or discovering what is the best approach in selling premiums, or the safest approach, or the approach that matches my personality, the approach that's not too stressful, the approach that I can place during the day and not have to look at the market all day and just enjoy my day. Which is kind of why I like the SPY put spreads that I was placing every Monday, Wednesday, Friday, because I would literally just place them and just not even look at them. If they ever get tested, then I start selling my call spreads. And I actually put a limit order to close the put spreads for 50%. So if they have a chance to become a winner, they get closed automatically because I put a limit order to close. And if it gets tested, then I sell call spreads against it. And it's just that lately these call spreads have been annoying me because every time I sell a call spread to protect a put spread, the call spread gets tested, and now I have to bring the put spread higher, the put side higher, and the trade ends up losing money. And I guess sometimes the amount of money I lose from the put spreads ends up wiping out all the small profits, since I close my trades for 50%. So I don't really make max profit. I always make 50% of the profit, but then when I lose probably $200 per put spread. So not that fun. And if we go through another March again, I would lose a lot of money with my put spreads, because even if I because I would go through a period of 1 or 2 weeks where every put spread I open is going to get tested, and even if I'm trying to save it by selling a call spread, it still becomes a losing trade. So yeah, I really haven't decided which strategy or which approach to take in my margin account, but it's definitely something around either selling put spreads Monday, Wednesday, and Friday for 7 days, or selling put spreads from Monday to Friday, that's it, or selling naked puts from Monday to Friday. So these are my 3 choices that I haven't decided yet. So while I'm in IQ Edge, let's look at Spotify just to see what what my strike is at right now. What's the probability of winning? So the 250 strike right now is giving me a probability of, so the 250 put is giving me a probability of 18%. So that means it's got an 82% or an 81% chance of winning right now. As we stand, my 250 strike has an 81% chance of winning. So why isn't it winning? I guess I have to wait till Friday. So you can see it's trading between 170 and 195 right now. Not good. Spotify's at 263. I'm 13 points away, but I mean, it opened today actually. It reached today 255. See, the low of the day was 255 today. So I could either maybe get out of the trade if I can't handle the stress, or I just have to hold on and wait and just ignore it. I know that I have an 80% chance of winning. Just let the probabilities play out. Even if this one loses, hopefully it doesn't lose that much. But next week, if I keep placing these trades every week, the overall should be profitable if I respect the 80% probability. Alright, so let me know what you think. Please leave in the comment section below. And like always, if you're going to open an account with Questrade to trade on the stock market, use one of my referral codes below. One of them gives you up to $250 back depending on your deposit. The other one gives you $50 in free trades regardless of your deposit. And if you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.